Accurate and actionable information can be very difficult to find in today's environment. Given the sheer volume of opinions that are out there, it can be challenging, but even more important, to identify a few key resources that you can actually trust and allow those resources to weed out a lot of the noise, as well as some of their own personal bias. Our guest for today is certainly one of those resources for me. Not only does his firm spend millions of dollars each year tracking different data points, because of how they're positioned in the marketplace, they have a great network of leading operators, investors, and fund managers. And those conversations, combined with the data they have access to, gives him a very solid pulse on the market in a variety of different asset classes, something that is not the case for many investors. Now, this is especially important in today's climate where every quarter we're getting new information, every week we're getting new information. And I think the people that have access to accurate information and those who are willing to take action are going to be the ones that succeed in the wake of these challenging times. So in this episode today, we're going to discuss the multifamily sector, the self-storage sector, and the senior living sector. And we're going to go into a lot of details into each. We're going to start with how the multifamily sector is being impacted by the combination of the unemployment numbers as well as the moratorium on evictions. We're going to talk about if the self-storage asset class is going to continue to prevail during these unique times. We've actually seen a lot of very positive data points. Now, I don't want to be overly optimistic, but it does seem like self-storage has held up quite well during this challenge. And also, what does our guest anticipate that investor appetite will be for the senior living sector in the wake of COVID? This is something that we've seen a lot of tailwinds. I think you guys are all familiar with how I think this asset class is going to play out over the next 5 years or 10 years. But in the short term, what does investor appetite look like? And what's the lending like available for all of these asset classes? Now, again, I want to thank you all so much for your listenership. I've really enjoyed putting on the show. We've done more than 200 episodes now. Hundreds of people that I've interviewed that I have a ton of respect for. I've learned a lot. I know you have as well. If you have listened to 3 episodes and got a lot out of it, do me a favor and leave us a review in iTunes. It's free to you. It makes a huge difference in terms of the show's visibility, and it really helps our ability to attract high-quality guests like our guest today. When I send out an email saying, hey, I'd like to be on our show, if they're not already familiar with the show, the first thing they do is check the number of reviews. That's the easiest way they can figure out if people actually care about the program. And I know there are thousands and thousands of you out there that are listening to this program that have got a lot out of it. So again, that's the rule. If you've listened to 3 episodes and you really enjoyed them, do me a favor, leave a review, and I'd really appreciate it. All right, hope you enjoyed the episode. How's it going, everyone? Our guest for today is John Chang, who serves as the Senior Vice President and National Director of Research Services for Marcus Millichap, where he is responsible for the production of the firm's vast array of commercial real estate research publications, tools, and services. Last year, Marcus Millichap authored 900 reports, briefs, and studies covering 10 different commercial real estate property types and developed more than 250 presentations that were delivered at a wide range of events. Mr. Chang regularly speaks at conferences, corporate events, webcasts, and client engagements, sharing his insights into major economic trends and how they will influence the performance of commercial real estate. So, you know why I'm so excited about having him on again. John, thanks so much for joining us.
Thank you, Hunter. It's great to be back on the show again.
Much appreciated. So we'll link to your previous appearance in the show notes page. Obviously, things have certainly changed since your first appearance on the show. And today, I want to ask you a lot of questions. I want to keep it to 3 asset classes that we've been focusing on, which is multifamily, self-storage, and senior living. And I will go ahead and give a pitch to Marcus and Millichap right now. You guys do an absolutely excellent job of providing data. Anytime you're interested in getting a high-level overview, whether it's quarterly or biannually, Marcus and Millichap provides free reports available on their website. So first of all, that's just a fair and honest introduction. But let's start with multifamily and work our way towards senior living. From a big picture, what are you seeing in the multifamily sector, particularly as it relates to occupancy and collections?
Sure. So multifamily has actually been faring very well. You know, we came into this year in a very strong position. We had vacancies very low and great expectations of where the economy was going to take the sector. We saw a lot of value gains and very tight cap rates. And then, of course, we have the pandemic and the health crisis that hit. And that really changed a lot of things in the marketplace. And in terms of what we've seen so far with rent collections, I've seen a variety of numbers crossing the news and the wire. And you really have to look at it closely, because sometimes it's saying that rent collections are 80% or 83%. But if you look at it, it says it's at this number, but it's about 3% or 2% off of last year. So when you scale that across the different property types, it's really just a minimal difference in terms of collections so far. And we have some good numbers on April and we have good numbers on May. What investors need to be looking for going forward is that a lot of the rent collections from tenants right now are being supported both because of the stimulus checks and the expanded unemployment benefits that are helping people through this challenging time. But a lot of that stuff burns off this summer. And if we're still in this downturn and a shutdown from the pandemic, then the stress on the rent collections may start to show up in August or September. So for right now, things are looking fantastic, quite honestly, better than anyone expected, but there still are some risks that are out there.
Understood. And in that response, you mentioned the different property types, whether it be Class A, Class B, Class C within multifamily. How are you seeing those different property types, or classes, I should say, impacted by this? I think the big picture thesis is that Class C or below is being most impacted. But at the same time, I could understand that the stimulus bills on a gross dollar basis have been more directed proportionately at the lower classes, people that have lower income and therefore lower cost of living. What are your thoughts on that?
Yeah, it's in terms of the occupancy rates or the vacancy rates, we haven't seen a lot of movement because there is a shelter in place going on. There are eviction moratoriums and some other things that are keeping those occupancies there, where you're seeing a little bit more stress in Class C properties than the others. But I was on the phone with a major investor who is predominantly in Class C properties, and he said so far his rent collections have been quite good. He's been, again, just a couple % off target. Where you do see more stress, and that investor is concentrated more in the central U.S., okay. Where you see more risk is in coastal markets, higher cost markets in that Class C segment, where your average rents are significantly higher. And even with the expanded unemployment benefits and the stimulus checks, that still only covers a portion of their rent. And that's where you're going to see the greatest stress over the short term. The higher tier, the Class A, especially in, say, tech markets, are still doing very well. And the Class B has been holding up pretty well also.
Okay. So sounds like that thesis is coming to fruition. People who have jobs making $100,000 a year that are much more likely to be able to work from home, for example, less likely to be impacted by shelter in place, for example. So I think that's all pretty much aligned with a lot of the conversations that we've had. In terms of the eviction moratoriums, what are your thoughts on how this is going to play out? There's a lot of companies that have been exclusively focused on agency debt. There's some advantages, there's some disadvantages. Speak to that and your thoughts on the topic.
There's a wide range of moratoriums that are out there. Fannie and Freddie automatically slapped on a moratorium on anybody who had agency debt on their properties. That's about 50% of multifamily properties out there. And that's burning through pretty quick. I think that was a 60-day automatic moratorium. It was a very short thing. Some states are extending it. And if you use a Fannie Mae or Freddie Mac forbearance, you are extending that dramatically, another 120 days before you can file. And then even after that, there's another 30 days of processing time and so on. So you may be looking at 6 months where you're unable to evict a tenant depending on the local rules. And there's other cases where there is actually no true eviction moratorium, but the courthouses are closed. So you can't file even if you wanted to. In terms of the impact, on one side, it really hasn't mattered so far, right? Most of the tenants have been paying their rent, so this has not really been an issue. The problem comes with one or two bad apples, who may be trying to take advantage of the situation and think of this as a rent holiday, but eventually they're going to have to come to terms with this. But there's also been a lot of movement towards the concept of rent strikes, and there's an entitlement to housing. And again, at the end of the day, this will be sorted out in the legal system and through courts and through an eviction process. And that tenant is ultimately going to bear the impact of that, whether it's actually paying what the past due rents are or simply just through an eviction process and the impact to their credit. So, the moratoriums, they make sense, really honestly, because the whole idea of sheltering in place was to flatten the curve and to reduce the infection rate of the COVID, but it will burn off and it will come to the end of that. And then, we'll transition into the next phase of the market over the summer.
Yeah, it's really interesting. We've seen a couple of states relax those orders, and Texas, which has been obviously a market that I'm sure many of your clients have been focused on for the last 10 years in particular, starting to relax that. Florida starting to relax that. So hopefully we'll see some of those markets' economy start to, I don't want to say return to normal, because that seems to be quite out of the question at this point, given the cultural change was just taking place. I think that people are really scared right now. And we've seen some data from China, which now those restrictions have been lifted. At least that's the information that I have access to. And we've seen traffic data where during the week, the traffic data is about 90% of what it was pre-COVID. But during the weekend, the traffic data is about 20% of what it was pre-COVID, meaning that people have to go to work, they'll go, but they're not going anywhere else, basically. So, that can have a huge impact on the economy, even if everything is lifted all at the same time. What do you think of these forbearance programs and how they will impact the market long term?
Yeah, again, for multifamily, the forbearance has been pretty limited. So, when it comes to the debt on the property, you're going to get a very different experience when it comes to forbearance. So far, CMBS debt, the services and special services have not been very actively engaged in providing any forbearance. In fact, in many cases, people are having a very hard time even reaching their lender and their servicers on that kind of a loan. Mm-hmm. Then there's the Fannie Mae and Freddie Mac forbearance program. And basically what they've allowed is 90 days of forbearance, but you have to repay that balance within a year. So you're getting off the hook in terms of making your loan payments for 3 months, but you're going to have to cover those missed payments within the next 12 months after that. And that really kind of, from most investors' standpoint, has missed the mark, because if you're asking for forbearance, it's because your tenants aren't paying you and you're still acting as the absorber of that missed payments. And in many cases, you're not able to evict your tenants. So there's a bit of a catch in there. And I haven't really heard of a lot of investors using that forbearance yet. The place where the most help is coming from is the banks. The local and community banks have been far more understanding of the dynamics and are much more interwoven with the community, and they have been better at finding solutions. Most of the time what they're doing is deferring payments and tacking those on at the end. So we're going to take 3 months off, and then we'll just extend your loan by an extra 3 months down in the future. So that's probably the most lenient of the programs. But again, because rent payments have been coming in very high, generally speaking, occupancies have been staying relatively high. Most in the multifamily sector have not been having to go back in and get the forbearance from their lender.
Okay. Yeah, that makes sense. And that's actually good to hear. And I think that the strings that come along with the forbearance, especially with the agency debt, most likely makes it something that is not desirable. So we'll see how it plays out. It's a tool that I think the incentives are there to not use it. It's very dangerous to have a property which is leveraged in which you're unable to evict tenants, especially for an extended period of time. That can create some really challenging situations at the property level. So definitely something to keep an eye on. Let's transition over to self-storage. Originally, when this started to become very clearly that it was going to be a problem in the United States in terms of COVID and the surrounding concerns of potential lockdown, the public markets reacted in a very pronounced manner, with senior living taking a massive hit in the public equities. Self-storage was significantly impacted, but was least impacted in terms of the main commercial real estate product types. What are you seeing now in terms of how the self-storage market is responding to, adapting to, and performing in a post-COVID lockdown world?
Yeah, I was just on a call with a half a dozen significant investors in the self-storage space. And there was actually a great conversation about adapting to the new normal and health crisis. There is an emphasis on automation. They're integrating more technology. They are looking at different ways to interact with customers. There's a definitely concern with having somebody on site and interacting with customers, and they're trying to find ways to distance. It's kind of like what you're seeing in the grocery stores with the, sneeze guards and that type of thing. The overall performance, though, has actually been kind of surprising. We saw a lift in demand, a little bit of a lift in demand, because the colleges closed early, and a lot of the college students put their stuff in storage and went home to their parents' house. And so we saw a little bit of a bump there. Also, some of the businesses that have been closed during the pandemic and the lockdown period have also used self-storage space. And so there has been a lift in demand and occupancy levels, although it's a marginal one. There's also been very good rent collections. Again, I was on the phone with those investors, and they were indicating that their collections are on par or actually even better than where they were a year ago. So they are not seeing any distress yet, but they're waiting for the shoe to fall, right? So a lot of these self-storage facilities have automated payments. They're charged under credit cards, and so those bills are still being charged and paid. The question will be, if this extends longer, whether or not people will start to notice those bills and say, gee, you know what, we better do something about that storage that we have and go about and remove their goods from those units.
Yeah, I agree. And I'm actually seeing very similar things. We saw, especially with the properties which are positioned near universities, we saw a bump, which we would typically see in June, for example, take place in the middle of April or the beginning of May. And that did create a little bit of bump in occupancy. We also saw and are continuing to see businesses, like you say, that are shutting down that still want to, I wouldn't say go into bankruptcy and do all that, but let's say that they have a industrial space. They're not going to close down their business, but for the time being, they can't operate. A great example of this is, anything related to the event service business. So if you have a cocktail business that you provide cocktails at weddings. Weddings are basically not taking place right now. So got to move all those cocktail making, materials into storage. The challenge, though, is that when your business shuts down and you have to go home from college unexpectedly, sometimes not graduating because of classes being canceled, sometimes classes being canceled, but businesses are likely not hiring at this time. The challenge then becomes, where's the income going to be derived for rental increases, which is a big part of the self-storage business, maybe even more so than other businesses, because you can, on a proportional basis, raise rates much more significantly. What are your thoughts on rental increases, and what are you seeing in the marketplace in terms of that dynamic?
Yeah, we've seen it really flatten out. We were getting a little bit of momentum, but there's a couple of factors coming into play there. One there's the impact of the health crisis, but the other is the significant wave of development and the competitive climate that was created by that. So, we have a lot of new units that came into lease up, and they were discounting in order to get their property stabilized. And that flattened overall rent growth a fair amount over the last, years and years. But now with the pandemic, a lot of the self-storage facilities are not seeing the ability to grow rents. But actually, on top of that, again, a lot of the investors I was talking to said, we're just simply saying that, look, now is not the time. We're going through a crisis. Our tenants are, in many cases, having a tough time of it. I'm not going to push my rents right now. It's just not the right thing to do. And so we are seeing some investors that are taking it easy and holding off on that over the short term. They don't want to put somebody in a tougher position than they're already in, and they're basically trying to be good citizens and provide a service that people value.
Yeah, totally sympathetic to that, but I think it's good business for sure, good economics, and then I don't know how much that legislation is actually required because it actually lines up with not just, it feels like the right thing to do, but it's good business to keep your tenants in place. So very interesting to see how this plays out. You mentioned some new units coming online. There was a massive, historically significant increase in new projects being initiated around 2017. And a lot of those projects were intended to come online right around 2019. It usually takes about 18 to 24 months to lease up facilities to get permanent loans on them. What are you seeing in terms of properties that were in the middle of those lease ups? Like, are you starting to see distress already? Are those developers getting concerned about their assets, or have they had enough time before this started to take place to overcome that big challenge?
Yeah, well, first of all, yeah, there was already a little bit of a challenge on leasing up some of these properties before we had the health crisis, and it's been exacerbated. And so now you kind of end up in one of two buckets, right? There are the seasoned industry veterans who have planned well and have well located properties and developed a quality product, doing a lot of market analysis. Those guys will generally be fine. They are seasoned, they know what they're doing, and they're going to get through the process, and they're generally well capitalized. Then on the other side, the strong dynamics of the self-storage sector, the growth and all of the momentum did draw in some new entrants, people who didn't know the business as well. Their site locations were probably not as good. Their operations are not as well set up. And so they just have a lot more risk going in. They weren't probably as well capitalized as others. Those newer entrants into the market, those less experienced investors who came in and started developing in self-storage, do face the most risk. We're not seeing a huge wave of delinquencies on those yet, but the risks certainly point to this coming, depending on how long we're in the crisis and the shutdown. We're only a couple months into this, really, so we're still in the area where people have some coverage and some capital to cover their investments. But the longer this runs, the more risk those particular investors face.
One of the benefits of self-storage is that the product type is not actually housing people. At least it's not supposed to be. And so the legislation around the asset class is much more lenient in terms of things like, closing down a property or not allowing someone on the property if they haven't paid rent in a certain amount of period. There's just much less burdensome laws. They're much more property owner favorable than they are renter favorable, for example. But we still have seen some prohibitions coming in terms of, putting property up for auction, which is common in the industry, or what some people would consider, quote, evictions. What are you seeing in terms of either legislation or state-specific guidelines in terms of how you should act if someone goes late on self-storage rent?
Yeah, there are some restrictions in some states. About half of them have something in place that impacts the ability to have a traditional auction, lien auction on those properties, whether they're restricting the actual auction itself or simply restricting the ability to physically have an auction. So there are some restrictions. Again, a lot of the investors I was talking to have kind of drawn a line. They said if the tenant was already having problems before the pandemic hit, they're probably still having problems. And if they haven't come in to communicate, then they'll probably move to an auction. Many of them are moving to online auctions. It's a very effective solution in many cases. And then there's the other side where people were impacted by the pandemic. They lost their job and they're having a tough time and they're willing to work out some sort of payment plan or something like that. In those cases, a lot of the operators are taking a little bit more lenient stance and saying, okay, let's work something out. But the auctions themselves and the eviction process itself has some hurdles, and it just depends on which state you're in, but it's not nearly the same magnitude as, say, multifamily.
Understood. Okay, anything else on self-storage before we transition to senior living, which is obviously a completely different conversation?
Well, the self-storage, again, you're seeing a really good performance right now. It's probably one of the best commercial real estate asset classes right now. And it does look like it has some longevity. Again, the questions that emerge are for, third and fourth quarter. If we're still in a shutdown situation, if we're still way down on our job count and people are not getting the unemployment benefits anymore that they were, the federally expanded benefits, then you may see more challenges ahead for this property type.
Understood. Okay, let's transition over to senior living. This is a unique asset class because the income that's paid at the property level is not paid based on employment. It's usually paid from savings, from Social Security, from equity in a home, from maybe a daughter or a son that is usually making $100,000 or more in a job that can be done from home. So the NOI is not really the concern. It's more about the actual virus, the transmissibility of that virus, and the fact that the senior living tenants are at a higher risk. What are your thoughts on the state of senior living, and what are you seeing in terms of the data in the asset class?
Yeah, and even within senior living, there are several subtypes, and they're each facing different challenges depending on their exposure level. You have the independent living, which is the most like an apartment, traditional apartment, as well as assisted living and acute memory care, and then skilled nursing. Most of the biggest challenges so far have been in the skilled nursing space. And of course, we have this very significant susceptibility of our elder population to COVID-19, which is exacerbating the challenges that are out there. And as a result, operators in the senior living space are facing a variety of pretty significant issues. First of all, there's the health concerns, and not only for the tenants, not only for the people living at the senior living facility, but also for their workers. And the cost surge in personal protection equipment that has resulted is really hitting a lot of these operators pretty hard. In addition, they have a lot more cleaning requirements and sanitization requirements that are also expensive. They're actually requiring more staffing. They're adding staff at a lot of the facilities in order to handle all of the extra things that are required from this. And so that's impacting them as well. I guess the good news is with rising unemployment and so many people losing their jobs in retail and travel and tourism industries, the seniors housing sector is actually hiring and recruiting people to help with these facilities. But that's really where a lot of the challenges come in, is how do you care for an elder population that is at risk? And, there's an open question, is somebody safer in a facility or not in a facility? And, that's an open debate that's going to affect and is affecting occupancy levels at these properties.
Well, actually, that's a good segue. I mean, what are your thoughts on that particular topic? Oh, not only in terms of what, the answer to the question, but I mean, what is the marketplace saying? Because I've definitely originally was very concerned that people would be skeptical of moving into the facilities. I have anecdotally seen a lot of evidence that there's a tremendous demand for people to move in because they want to be in an environment where there's professional help. But we only have access to a couple of properties information. So I'd love to hear your perspective. You have a more aggregate view.
Yeah, it depends. You're really at the operator level, they have to be able to demonstrate that they have good policies in place and that they are taking care of their tenants and ensuring their safety. For a well-run seniors facility, a skilled nursing facility where you have more of the risk, but even in an assisted living facility, they have to have, demonstrations on how are they handling visitations. And in fact, most of them are not allowing visitations. They're really trying to beef up their technology to allow, video calls and that type of thing. But just to ensure their tenants are safe, they're not having people come in. They have to have the proper personal protection equipment and so on. And that's really been a key. Overall, occupancy levels have ticked down a little bit, but I think that they're going to recover that pretty quickly for a couple of reasons. One, we've seen a slowdown in construction, right? So we were already seeing a slowdown in construction coming into this, but now with the health crisis, construction is slowing down even more. So your risk of new properties coming online has come down dramatically. But also, people have been locked down. They've been locked in their homes for a couple months now, and caring for an elder person is difficult. And so for those with the means, as you pointed out at the beginning of this segment, it's not inexpensive. But for those with the means, a care environment where you have professionals and you have medical staff available actually is a safer environment for family members than what you can offer at home in many cases. So I think that we do see a little bit of a dip right now in occupancies. I think that's transitional in basis, but we'll see it recover over the course of the next several months.
How do you think this is going to play out over the long term? I mean, give us your thoughts on the senior living space right now, generally in terms of, pre-COVID world. And then what do you think this looks like in 2 years and 5 years in terms of investor appetite, in terms of cap rates, in terms of, given that this most likely will be around for quite some time? I mean, how does the senior living business operate in a post-COVID world?
The momentum behind investing in this property type really centers on one thing, and that is demographics. And ultimately, regardless of COVID or any future health issues that emerge, those demographics play through. And we have, 70 or 75 million baby boomers in this country now in their 60s, pushing into their 70s. And as they're aging, the demand for additional services focused on the elderly become more and more valuable. So there is, of course, the health issues and the short-term challenges, but looking forward 2 years, 5 years, we're just moving into the steep incline of people turning 70 years old. And that's a positive factor supporting the case for seniors housing. And that's true whether we have a pandemic or not. Now, as we move forward, we're going to be introducing more technology into the facilities. We're going to see more safety and health management as part of the operations. I think that we're going to see behavior changes and adaptation from the seniors housing field that will support the operations. They may be a little bit more expensive to operate under that model, but ultimately the demand drivers are being driven by something bigger. It is a population segment that is enormous that will be requiring a lot of these services.
There was definitely a lot of concern in the public markets about this. There's a concern in governments as well. And so because of that, the CARES Act put in a significant amount of capital specifically dedicated to the senior living space. What can you talk to us about in terms of the senior living space being a benefactor of the CARES Act? How do you anticipate that playing out as those funds become available?
Sure. So senior living providers have access into a variety of funds, and some of them are loans and some of them are grants. And it really was demonstrated early on that there was an importance to ensuring that the senior care facilities had the right resources available in order to protect the people who were living there. There's also a lot of the senior living providers qualified for the Paycheck Protection Program, which was through the Small Business Administration. And those are federally guaranteed loans up to $10 million that basically allow companies that have 500 or fewer employees to borrow the money, but if they use 75% of it for their payroll, then it's forgiven. And that's been a really important factor for the seniors housing sector, but for the economy as a whole as well, because what it has done is it's helped stem the tide of job losses from the smaller companies. And it's helping these operators in the seniors care facilities who are having to add additional staff to care for their tenants to cover those costs and make it over the hurdles of the next few months. Now, where it goes from there is the real question. Again, just as I keep mentioning, we look forward, right? So for March and April, it's fine. May and June is probably good. You start pushing off into the third quarter, and that's where you start to have a lot more questions, because a lot of these funds from the government stimulus were designed to last a few months. And the question will be, if we get a second wave, if we have this shutdown extend way longer than we expected because we're not able to flatten the curve as much as we thought, that's where you start to hit the problems. And that's, again, where we may see a new round of government stimulus show up if we get to that point. So there's a lot of questions about what's out on that horizon, but there's a lot of variables in play that can knock it one way or the other. So we're just not sure what that looks like yet.
Much appreciated. The critical component of this is the liquidity in the space. You've addressed the investor appetite for this. You've addressed the incredible momentum behind the asset class, which a lot of listeners are already familiar with. But what does it look like on the debt side, right? So capital stack is made up of investors for sure, but also institutions, banks that lend in this sector. Is there availability for financing right now? How has that changed since this new concern has entered the marketplace?
Well, there is capital available. However, it's not what it was, 3 months ago. It certainly is down. When you look at liquidity in the marketplace in January, February, it was exceptionally high. It was still very, very strong. Right now, we're seeing a lot less activity. CMBS lending is minimal at best. In fact, it was recently basically in a complete lockdown. When you look at Fannie and Freddie financing, it's been out there and it's available, but they have increased the reserves significantly. And so when an investor is going to buy a property, if they're using that, their reserves are so significant that the math doesn't pencil over the short term. Now, a lot of those reserves can be recovered. So there's a means for that over a period of time of operation, but still the cash outlay is pretty high. The most accessible capital is through local and community banks, especially if an investor has a good track record with one and an existing relationship. That's the most liquid segment, as well as local credit unions also. They've been lending pretty actively as well. But it is certainly a place where you have to have a really good financials, and a pre-existing relationship is very helpful in accessing capital there. Certainly there's lending available from banks, large banks, and other institutions, and it is available, but the rates have been a little higher than what we've seen in the past. Even though the 10-year treasury has dropped down to, 3/4 of a point or 2/3 of a point, the yield spread on the financing has opened up dramatically. So their cost of capital today is actually higher than it was at the very beginning of this in March when rates were very low. So it's there, but expensive.
Two really important questions. First of all, how do you track that information? Is a lot of this through conversations you're having with leaders, principals at these various firms, or investors, buyers, et cetera? Or is this information that we can track at home, if someone's listening to this, for example?
Right now, most of the information is coming through network.
Yeah.
Marcus Millichap, we have 2,000 brokers and investment professionals that I can reach out to and talk to, and literally thousands and thousands of clients that we're interacting with. I'm actively engaging in a variety of calls with key clients across the country, and they range from the very largest institutional investors right down to some very small private investors.
Yep.
So that we can get perspective. Most of this isn't out there yet. The data is always lagging.
Right.
And so the numbers that we're seeing in our reporting just isn't capturing it. Most of it's still first quarter stuff, but the communication and the interaction with other people in the industry is key.
Yeah. Well, listen, I really appreciate you coming on because our listeners are obviously keen to get that information as quickly as possible. And it's one of the reasons I really enjoy these conversations, because you've been open about a lot of things you're looking into the future in terms of the Q2, Q3 things, but you can front run that information if you have access to the network that Marcus and Millichap has developed over the last several decades. So very much appreciated. One question about the yield spreads there. How do you anticipate those yield spreads moving into the future? I mean, it's very common that those spreads between a 10-year and a mortgage can exist, but over the long term, they tend to coincide very well. What are your thoughts on the timing in which you will see that spread where the cost of capital should be down, in fact, it's up, kind of being eliminated, the delta being reduced to pretty much zero?
Yeah, it's really just tied to uncertainty. And right now, nobody can really put their finger on where we're going to be in, 2 months, 3 months, 5 months, 6 months, or even a year. They don't know how broad reaching the damage will be because we can't identify the magnitude of the health crisis. We can't say, oh, well, we're going to get done with this in 3 months or 6 months. We know that there's a vaccine or some sort of cure being researched, but you can't say when it's going to happen. And as a result, the financial institutions, as well as investors, really are having a hard time pinning down what the future looks like. And because of that, they've opened up their spreads. And it won't be until we have more clarity on what's happening in the marketplace in the future that those spreads will tighten back down again. Either that or the other way it could happen is through even more aggressive Fed action or by government policy. Those are the only other things outside of reducing uncertainty that could affect those spreads. And I don't see either of those impacting it yet. I still think that's a government action is still a ways off on something like this.
Yeah. Well, listen, that's a really good summary of the asset class. Agree completely there, and really good to hear that additional information. Any other thoughts on the senior living space before we close out?
No, it's a long-term play. And, it's not for somebody who doesn't really know and understand that sector, especially right now. But for those who are seasoned in that space, we could see some opportunity, and especially some of the larger investor organizations could be well positioned to expand their footprint because they have a deeper bench in the medical side of it. But overall, if it's an experienced investor, there may be opportunities coming in that space. And again, it's looking to the future, looking out 2, 3, 5 years down the road that the true rewards are earned.
Great. Well, John, again, I really appreciate the conversation. Looking forward to having many of these down the road. Before we jump off, though, let the listeners know how they can learn more about you and your reports over at Marcus Millichap.
Sure, absolutely. If people come to the Marcus Millichap website, marcusmillichap.com, there is a research section. We actually do have a special section of the website dedicated to the pandemic and COVID-19. My team has actually delivered over 50 reports, videos, and other material so far, specifically on the impact of the pandemic on the real estate market. So we have a lot of good information and insight available there. And you just go into the website, log in, and you can access all of it.
All right, John, thanks so much.
Thank you. Appreciate it, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.